Welcome to Getting Real with Real Estate with Danielle Kempf and Jim Kempf, St. Louis's favorite father-daughter real estate team. Your source of real estate information in the greater St. Louis area.
All righty, we on?
We are on.
All right, here we go again.
Let's do it.
Time for another podcast.
A very
Welcome
exciting
to everybody.
podcast today.
We got it. Yeah, this is a good one. It's kind of important, really. We've talked a little bit about it before, I think.
We have
in
earlier
in some
episodes.
podcast. Yeah, a couple with some lenders. We mentioned a little bit about what we're going to talk about today. But before we get started, of course, we always have to.
We have a joke.
Start with a joke.
That
Should we
ties
tell them
in?
what
No,
we're...
I think we say the joke and then
say
let
the
them
joke
guess.
first. Yeah, there you go.
Okay.
All
right. So the joke of the day: why did the mortgage start a blog?
Why did the mortgage start a blog? I don't know.
We have a blog.
We do.
We do. To tell its interesting stories.
The mortgage.
Mortgage. It's interesting.
Interesting.
Kind
They
of.
are. That is interesting. Well,
So we just kind of spilled the beans. We're talking about credit scores today.
you think somebody would have guessed that just by talking about that? Maybe.
Well, I mean, mortgage and interest, maybe not.
Yeah. Well, credit scores is important because it can determine like how
A lot
much
of
interest
things.
you pay over
Yes.
your life, right?
Yes.
That's one
That's
thing.
how it ties in.
That's how it ties in,
That's
I
how it
guess.
ties
So
in.
that's good. So I guess the very first thing we should talk about is just really what in the world is a credit score. Everybody talks about it.
Yeah. It's
Right?
three numbers.
Ooh, my
but
credit
what does it
score is
mean?
good, or my credit score is bad, or it's a certain number, right?
As long as you say it's not zero.
God, I hope not.
Unless you're like a toddler who just has never had a credit card, but
Right. So really, just a credit score is just it's a 3-digit number. Why it's 3 digits versus 4 or 2 or whatever, but it's a 3-digit number. It's usually runs between about 300 and 850.
sometimes I've seen them as high as 900.
Yeah,
though.
different. You're right. I think there's different models or scoring models.
Mm-hmm.
But what it is it's just a number that kind of represents the likelihood that you're going to repay your bills.
On time.
Essentially, right? It's a predictive model, right? Like a lot of things that tells lenders or tells creditors the likelihood that you're going to pay your bill.
Yeah.
Right? So if you're 300,
Maybe not.
maybe not so likely.
Maybe not paying your
If
bills
you're-
on time.
If you're 850, you're probably a little
You're
more
doing
likely.
pretty good.
So that's good. So,
Oh.
just go ahead.
I was just going to ask, what is it made of? Like, how does someone calculate their credit score? Can I just like start doing some math and calculate my own, or?
No, not really. Exactly. So like a lot of models, right? There's different pieces of the puzzle, I guess, if you will.
Different like reporting agencies, I would say, even that have their own models that you're talking about.
Yeah, the one we're going to talk about first. Well, it's your FICO score,
Yeah.
right? Is and how it's made up or how it's derived. So 35% of your total score is based off your payment history.
Yep.
That's pretty self-explanatory.
Did
right?
you make your payment on time?
Yeah, if you make your payments on time, you get a good
score.
You get a good score for 35% of your overall.
Yep. And then the next biggest amount is 30%. So that's the amount owed.
Right.
So that's how much credit you've used versus how much you have available.
Correct. Yeah. So if you've got, should we throw an example? Let's use an example.
Okay.
If you have a credit card that has $1,000 limit, and you're using $400 of it, you're at 40%, right? You're at 40% of your limit. So that's your utilization, 40%. So
I had to
that's
do
how
math
we're-
in my head for that one.
Right. I was going to get the calculator out, but I tried to keep it simple. Another factor is the length of your credit history. That's, again, kind of, for somebody like me, I'm a little older, right? Mine goes way like 36 or 7 or 8 years.
Yeah, where I'm in my 20s, I got mine
Yours are going to be short.
high school.
Right,
Yeah.
but a deeper file, a longer file, is obviously going to give you a little higher rating just because you've been around longer, you've been paying bills longer and all that kind of stuff. So that.
Or even if you've just been using it periodically. You don't have to use it every day. Just periodically use it, pay it off on time. Just like you said, shows that you have that credit history that you're paying it off, that length of it.
Yeah, the length of time is, that's just part of it. So
Yep.
the next part.
It's a credit mix. So what types of loans do you have? Do you have more of an installment, more of like a mortgage or an auto loan to pay off? Or is it more of like revolving credit cards? You put a tank of gas on it, online purchases, kind of a mix of that.
Yeah, and so revolving credit is, if you will, how do I say it? It's the riskiest type of credit. right? If you think about your mortgage is secured by your house.
Okay.
If you don't pay for that, you're going to lose your house. Your car loan is secured by your car.
Yeah.
If you don't pay for that, you're going to lose your car.
And then they make up the money. Like,
But-
if you default on your mortgage, they're going to get your house to recoup that money that you lost. Same with the car, I'd imagine.
Yeah. That's why. So they're secured, right? Those are secured obligations. But your revolving credit, if
Is
somebody
that my
on
own-
your
Is that
credit,
my Amazon purchase?
no, that's your credit card.
My credit.
So your credit card, if you think about it, right? You can go buy, if you got again that $1,000 limit on your credit card, and you go spend $1,000 on Amazon on that credit card, they can't come get your Amazon junk. They're not going to do that. So they're out, right? It's not secured.
Yeah.
So my point that I was trying to make in your credit mix, that revolving credit is actually weighed, I think, a little heavier. If you talk to most people familiar with credit, I'm pretty sure this is correct, because that's riskier credit to the person lending you money, if that makes sense.
That makes sense.
right?
That makes sense.
That's why that credit mix can be important to you.
Yep.
So you add all that stuff together.
Oh, one more. We missed one more.
Oh, the new credit.
Yep,
Okay.
just new credit. And that's just
Okay.
10% too. So it's
Got it.
less influential, but just do you open up new credit?
Yeah, and I guess too, have you opened up a lot of new credit recently? That's
Yeah, that's
risky.
probably a big one.
That's a
How many
big-
credit cards did you open at once?
Right.
Yeah.
If a lender sees that you've just opened up 7 credit cards in the last month, you're probably
That's kind of risky.
kind of risky, right? So, anyway, so that's kind of how it's made up.
Yep, that's what it is.
Let's talk about the good versus bad ranges is kind of where we were going to go next,
Yeah.
right? So.
We'll start at the top, I guess.
Let's go top down. So if you're like a 800
Or more.
or more,
depending how high it goes. Some 850, some 900.
yeah,
Roughly.
but let's say you're over 800, you're considered excellent.
Yeah.
Right? That's a really good credit.
That's
Obviously,
a really good one.
you apply for a loan, you're pretty much gonna get it.
Yep.
Right. Basically, 740 to 799 is considered very good. Right.
Just under that, 670 to 739. That's good. That's in the middle.
Yep. And then 580 to 699, that's going to be in the kind of fair range. You're kind of starting to push it on the downside
Push
there
your
a little
luck.
bit. You be careful there. And then if you're 300 to 579, sorry, but probably can't help you.
Oh, yeah.
That's.
But we can help you get connected with people who can help you restore that credit.
Well, and we can talk to you. I mean, here we'll probably give, I think,
couple
as we
pointers.
talk, a
Yeah.
little bit of pointers on how because sometimes, bad things happen to good people, and it
Situations
impacts.
happen.
Yeah, it can impact your credit score, but you can rebuild that. I guess is my message to people,
Yes,
right? It just
yes.
takes a little time, and you got to focus on it, but you can definitely do that. So.
So now that we know the credit scores, what's good, what's bad, I guess we'll go into next what the loans require. So what Fannie Mae, Freddie Mac, the different,
Yeah, that's
the
good for like
minimum
a
credit score for the different type of
Yeah,
loans.
of course, we're talking about mortgages, right? Because we're real estate people. So, yeah, so kind of tell everybody what kind of the ballparks or the ranges are there, Danielle.
All right, so let's start. We'll start with FHA because that's one of the lower ones credit score wise that you can get a loan for. So FHA, and I'll put this out here, some lenders have more restrictive regulations than Fannie Mae and Freddie Mac require. So this isn't gospel. Some lenders have their own different rules out there, but for the most part, an FHA, you can get a loan there with about a 500 credit score with a 10% down payment. So, if you have a 500 credit score, you're fair. I think that's what that was. And there, you're in the low to fair range with that. So you're going to have to put a little bit more down to show that, you're not just going to give your 10% away on the house, that you're going to try not to default on it.
Yeah.
But if you get a higher score, up to 580, you'd only have to put down about 3.5% there.
Right.
Next, with the USDA, you can get a USDA loan for about 580 or 640, depending on where you're looking at, depending on the lender there.
Okay.
And in St. Louis, we don't see a ton of USDAs. You have to
No,
go
that's-
pretty far west.
That's
for
more in
that.
the rural. Yeah, that's, gonna
that's
be
for the
more
rural
communities.
people
Yep.
there. A VA loan, technically there's no limit or minimum with it, but lenders at least like to see a 620 for a VA loan there. Same with conventional loans, 620 for that minimum credit score. And then a jumbo loan, those are, I think they're up to like
That's over like $740,000 or $50,000.
Yeah,
That's
so the big loans, you got to have a better credit score, so that minimum's a 700 there.
Yeah, okay. That makes sense. Yeah. So, and the high, and again, like Danielle said, sometimes if your credit score does happen to be a little on the lower range, you can make up a little bit for that by putting some skin in the game and putting some more down, which can help you. Interest rates probably be a little bit higher, and actually that's probably a good topic to roll right into, because there's a huge difference in your payment amount, right? If you as an example, right? So we just looked at a
$300,000 purchase price. 30-year fixed rate loan.
Yeah, so like just as an example, if you're in like a 640 to 659 kind of range, an average APR might be 7.4%, give or take a little bit, which would result in a payment of $2,082 a month, just principal and interest. Now, if you had a better score, 700 plus to maybe say 760 in that range, you may get a rate as low as 6.6, which would result in a payment of $1,916. So you're talking about $166 a month difference.
Yeah.
So if you over a 30-year loan, right, that's 360 payments at $166 a month, that's over $59,000 that you're saving. That's huge.
That's huge.
I mean,
over
if you really
30
think about
years.
that. So that's why that credit is important. And really, your credit score, even now, it impacts your car insurance, of all things. Yeah. Oh. So insurance companies now are looking at credit scores. Don't ask me. I mean, I don't understand necessarily why your credit score means you're a better or worse driver, but it really is part of it. Yeah. If you talk to any insurance people, they'll tell you credit score impacts your insurance. So. Work on that credit, guys. If if you happen to have again a bump in the road and your credit is not where you want it to be, there's ways to get it back and get that score up and help yourself save some money.
Yes.
One thing I think that confuses people sometimes is let's just talk about there's 3 different credit reporting agencies, right? So when people talk about their score, it's like, well, which one are you talking about? I guess sometimes that can be a difference, right?
That's a really big one there.
So there's 3 main credit reporting agencies. You got Equifax, TransUnion, and Experian, right? And they all are going to have a little bit different numbers. So if we ran credit on both of us today, your TransUnion score is going to be different from your Equifax score, which is going to be different from your Experian score. Yeah. And why is that?
They all just have different models, different things that they look at, I think.
That I think can be part of it, I think. And then, but also some of your lenders only report to certain credit bureaus.
Oh.
Okay, so you may have, I don't know, let's just say you may have a car loan at a credit union, and maybe it's a small credit union, and they report your credit to TransUnion and Equifax, but they don't report it to Experian, possibly, right? Or something along those lines. Yeah. So you're going to find some differences in those scores between the 3 bureaus. And then what you kind of alluded to as well, within each credit reporting agency, they have different models.
Yeah.
So if you're looking for a home loan, your mortgage lender is going to be running a mortgage-specific score on you. If you're looking for a car loan, there are auto loan-specific models, and I'm sure there are for revolving credit as well. So there's different models that you may be, pulling different numbers on.
Okay.
If that makes sense. There's so there's a lot of different, and it seems kind of silly in a way. Like I would think you should have one score, and that's your score.
Yeah, you'd think that, like your example with the car loan, you'd think they'd somehow automate it to go to all 3.
Yeah, exactly. But for some reason they don't, and I don't. Again, I'm not. That's a little over my pay grade. Yeah, I don't know why that's true. But anyway, so that is if you.
Or even I know our bank, we're with Commerce, St. Louis people here, we're with Commerce. Even online, it shows you, I think it's a FICO. And again, great starting point, not gospel.
Oh, yeah.
So, it gives you a good idea on what your credit score may be. But again, like Jim was saying, all the different bureaus are going to be a little bit different.
Yeah.
And so when you go to get your mortgage, don't they typically take an average of the three of them to kind of figure it out?
I think that's right. I think they do pull. So yeah, your mortgage lender will pull they'll pull all scores, and I do believe they average them. I think you're right.
I think that's right.
Or maybe they take the middle.
The highest two or something like that. Again, every lender has their own
different
kind of
policies or whatever, right? But but just know that they're pulling a different number. When I go on my Citibank to pay my Citi card, or whatever, it's same thing like yours. It's got a FICO score on there, but that's
different from
a different model than maybe
Yeah.
Commerce uses, and for sure it's different than what a mortgage lender would use.
Absolutely.
My score has always been lower on a mortgage one than it has been when I see those. Just always has been. I didn't do anything. It's all the same stuff, but it's it's just there's differences you just need to understand that they're not always all going to be the same.
Exactly. And let's jump into like the different ways that like your lender or the car company, I don't know, car business, how do they get your credit score? So there's different ways that you can pull a credit score. There's a soft and a hard pull. So the soft pull doesn't, I don't want to say make a ding in your credit, but it doesn't knock your credit.
Yeah, that's correct.
Whereas a hard pull,
so
I don't know the difference
a soft pull is maybe more like you're inquiring to see what your own credit is, right? You're checking your own score. Or you will always, a lot of times with like credit card offers, who has not gotten a credit card offer in the mail that says you're pre-approved, right? So what those companies are doing is they're doing a soft pull. They're not, you have not applied for a loan, right? Once you apply for the loan, they're going to make a hard pull and get but that they can do a soft pull that does not impact your credit. It's a little different.
I don't know what information they get off one versus the other, though.
Yeah, I couldn't really tell you that either, to be very honest with you. But just know that if you do a soft pull, or if some lenders, like you can call a mortgage lender, and they can do a soft pull.
Yep.
And
like
just say based on
for
a pre-qual, right? So they can kind of see. And I don't know if that just tells a score or if it just gives a general overview of your credit. It maybe just doesn't have details. I'm not exactly sure what the differences are, but
we'll get a lender.
Just know that there is a difference.
Yeah.
But that's the hard pull comes when you actually apply.
Yes.
And so you mentioned dinging your credit. When you do apply for credit, usually that inquiry does impact your credit score a little bit.
Yeah, but not for long and not much.
Right. It may be a few points.
Yeah.
I've heard anywhere from a couple to 4, 5, 6, but whatever.
Yeah, just a couple.
But you alluded to this as well. You talked about, like, let's say I'm out shopping for a car, right? And I'm going to 5 different dealerships because I don't know if I want a
Ford or GMC
Ford or GMC or whatever. You just went through that.
Chevy. I just did that.
So if you hey, what rate can I get when I go to the dealership, right? You may apply for a car loan with dealership A, and then you might go to dealership B and apply for a car loan 2 days later, and then a week later you go to dealership C and apply for a car loan. Typically, if you're doing that and you're shopping for the same for a car loan over a similar period of time, and that might just be a week or two, or it could be up to maybe a month or more, that'll be those 3 inquiries that we just talked about. That would be considered just one
pull. Yep.
Right. So because they can see that you're applying, you're looking,
you're shopping around, you're being an
educated
buyer.
Yeah, an educated buyer. I'm trying to get a good rate on my car loan, right? So same goes for houses, that kind of thing. So if you're looking, if
you're talking with different lenders here and there, and they're doing a hard pull, like Jim said, if you're talking to 2 lenders, 4 lenders, 8 lenders, as long as it's in that same amount of time, please don't talk to 8 lenders. As long as it's in that short amount of time, it will only count as one hard pull there.
That's way too
But then
much.
also, don't most of the credit bureaus, the theory that we talked about, they usually give you a free yearly pull, don't they?
Yeah, so something you can do on an annual basis, and this is really pretty important because believe it or not, there's
scams everywhere.
There's scams out there. There's fraud out there too, right? I have, back when I was in the car business a long time ago, I remember collecting on car payments and calling people, and they go, "Well, I never bought a car," but somebody got their information and bought a car under their name. So it is important to check your credit periodically, and you can go to each individual credit agency. Credit reporting agency once a year and request a copy of your credit report, which is good. You can sign up for credit monitoring, which actually is probably a pretty smart idea as well.
Oh.
And those kind of services also allow you to check your credit, to look, you can see exactly what's on there, pull your credit bureau anytime you want to.
And that's kind of unlimited pulls, right?
Yeah, that's not, you're just kind of logging in and seeing
Yeah.
what it is. It's like going into your bank account, seeing how much money you got. It's your credit report. So that's really a pretty smart idea as well, to check that annually, because if something were reported inaccurately, you can contest it, for one thing.
Yes.
And if all of a sudden you see a car loan on your credit and it's not you, what are you going to do? It's
Yeah.
better to find that out and to try to
Be
work
proactive about
to be
it.
proactive, to take care of that. You can also go to annualcreditreport.com. That is gives you a once a year freebie from all credit reporting agencies. It's been a long time since I've done that, but you can log in. You have to prove it's you. They ask you a bunch of questions, even specific to like certain things that are on your bureau that only you would know.
Yeah, like what
know?
kind? I think I did this. Like, what kind of make and model car did you have? And it give you like 3
something
options.
like
You have
that.
to pick it.
Yep. So it's that's really a pretty smart idea. So
Yeah.
if you're
And maybe you don't do them all at the same time, but space it out every 3-4 months or so. Pull from one, grab from the
not
other.
a bad idea. Yeah.
Instead of doing
just
them
to
all
check
at
it.
once.
But it is a good idea to check it once a year.
Yeah, that'd probably
however you
smart.
decide to do it, but that would be good. So I guess let's talk about a little bit for those folks maybe that again something happened and the credit score is
a little bit lower than what
kind of
you
lower
want.
than you want, right?
Yeah.
You're in the 400s or wherever you're at. What can you do? Let's just think about or talk about what can you do to get yourself back up to that level where you can think about buying that house or
Yeah.
getting that better deal on a car loan or whatever.
Your interest.
And I'm just going to go back through when we talked about what's in your FICO score, the very
Okay.
first thing, payment history, right?
Absolutely.
So just start today and make sure you pay your bills on time.
On time.
That's-
You can set up the auto payments super easy. Kind of set it and forget it.
Yeah, that's the biggest, and that's going to be the biggest factor, really.
Yeah.
You just have to get to that situation where you're paying everything on time and getting back to basics. Over time, right? The longer, if you had a late payment or 2 or 10, however many it was, the farther back in history those become, the better off your score is going
Yep,
to go.
I
So
think
that's going to help you.
One of the facts that I pulled is that a late payment will stay on your credit report for about 7 years. But
That's-
again, like Jim said, it diminishes in time, but it
Yeah.
will be on there.
Yeah, the farther back a lot of lenders, and I just talk about this based on what I used to do with Ford Credit, right?
Yeah.
Because I used to approve
You
car
were in the
loans all
finance
the time.
department of it.
Yeah, so I mean, if we saw where somebody had a situation, you could see it honestly. Like you could look at somebody's credit report and see exactly where their payments went bad, and it might have been 5 years ago,
Yeah.
and you could see, and then
It's like a timeline almost.
yeah, and then all of a sudden the payments got back on time, and they've been straight ever since. So when you see stuff like that as a lender, you're like, okay, well, obviously something happened, so you know these folks are back on track.
Yeah.
So that can help you as far as a lender goes.
And then paying down any credit that you do have on it. So even if you're just paying the minimum on your credit card right now, maybe pay a little bit more if you can. Start paying down that credit balance that you have.
Yeah.
Because the lower that, your debt is, well, let me back that up. The lower your debt is, the less your debt to income would be, which is, am I getting that right?
Well, your debt
no,
to
it's not.
utilization.
Yeah,
It's
debt
your,
to utilization.
Right. So what you're trying to do there is you're trying to free up utilization space,
your debt
right?
to credit ratio.
So going back to that very first example, I said if you got $400 on that credit card with a $1,000 limit, right? You're at 40% utilization. Get that sucker down to 20 or get it
Or
down
30,
to 10,
yeah.
right? Get it so start paying that off. The other thing I would just as advice, I guess, financially speaking, pick a credit card with the highest, especially if you have credit card debt. Pick one with the highest rate and pay that one off first. Right?
That makes sense.
Focus on getting that one paid off
Yeah.
first. Get it down, get it paid off, then go to the next one. Or if you want, it might feel better this way. Pick the smallest balance. If you got 10 credit cards take the smallest balance and pay that sucker off, and don't use it again.
Just don't close it.
Don't close it, but maybe cut the card up so you're not tempted to use it.
Yeah.
But I like what you said. If you close it, then you're just taking that limit away from yourself, and you're increasing your utilization.
Yeah.
So don't close it out, but pay them off. Get those things paid off as quick as you can. Open up some credit space. That'll help your score improve a little bit.
And open up your credit space. Don't open other credit cards.
Right.
Don't open
Yeah.
new lines of credit
Don't
or
get
take
new
out
ones.
debt or anything like that. That's
that's not
going to help
necessarily a
there.
good idea. Right. That's not necessarily a good idea. I will say sometimes it doesn't hurt you. Like if you get a small installment loan, maybe you have a couple credit cards and you can get a small installment loan to pay those off, and then you're paying you're kind of consolidating a little bit and then just paying one thing off. That might not be a bad way to go either. Any of those kind of things can help you just get that credit score back up. And again, it's a time thing, guys. It's long.
really is.
You got to really look at the long play.
Yeah.
But you will, as if you're making these strides, you will get
Your credit score
get
will
your
start
score
working.
back up. There's other things in talking about like credit repair and stuff. We're not going to get into that. We don't have time for that. But
But if you have issues with that, we can help connect you to someone to help kind of repair it maybe a little bit more quickly to get you back on track there.
Yeah, there are things you can do. So if that's a concern of yours and you want some information about that, we're happy to put you in touch with someone who can help you.
Yep.
I got one fun fact.
You have a fun fact.
I'm gonna make you
You're going to make me guess a fun fact.
Well, I was looking at average credit scores by state
By state.
in the United States, and I want you to get what state do you think has the lowest overall credit score average? Hurry up.
I'm going to say Alabama because I think they used to be the poorest
You're
state.
so close.
Was I? What
You're
is
so close.
I'm trying to cheat.
Actually, it's right next door to Alabama. Mississippi was with a 675 average.
675.
Alabama had a 685 average. So
675,
You were pretty
685.
close.
Pretty close there.
you were pretty close. Anyway, so that was my fun fact
But
for
what's
the day.
Missouri's?
Missouri's was, where is it? 705 on average.
Well, that's
So
pretty good.
That's not too bad.
Go
So
Missouri.
Good job, Missouri. All right, well, we're probably
We'll wrap it
about
up.
out of time. We'll wrap it up. So, again, that credit score is important, right? Just remember that.
If you're thinking about making a purchase down the line, whether a car or a home, just start thinking about that. Maybe check it and do a soft pull, do one of the free pulls. Just check it out and see if there's anything that you can kind of tweak for it to get you ready for when you're ready.
That's right. And if we can help you with that process in any way, let us know. We'd love to just have a chat and see how we can help you. Okay?
All right. Have a good rest of your day, everyone.
Sounds good. See you later.
You've been listening to Getting Real with Real Estate with the Kemp team. Have questions about real estate or something you'd like to discuss? Contact the Kemp team at 314-336-1926 or visit our Facebook page at facebook.com/the Kemp team. Don't want to miss any episodes? Follow us on your favorite podcast app or YouTube. The Kemp team. Real, honest real estate.